Hi guys, happy Friday. Hope everyone is healthy and well. So throughout sort of this whole crisis that we've been going through, one of the things that I've found myself being super interested in is what's going on with the economy, how our market's reacting, and kind of what can we expect at the end of this, and what have we really learned from the past, from the 2008 crisis, from the Great Depression that we had. There's so many things that we've learned in the past, and does any of that stuff apply to what's going on right now? Or is this just such a unique situation that we really can't apply past experience to this? But who really knows the answer to that? I think people are really trying to figure it out right now, especially the people who are really sort of in control of this type of stuff. But it's just all really interesting. So I found this article. This is a Barron's article that I came across, and it's actually one of the only articles of its kind that I found on the internet, because one of the things that I kept thinking about is, because there is so much job loss going on right now, such a big impact on people's income loss, it's gonna be a tough recovery if we don't bounce back quick enough. But the thing that will likely drag down people the most, more than anything, is debt. And we here in America know that most people do carry debt, whether it's in the form of your mortgages, your student loans, credit card debt, auto loans, so on and so forth. Most people, the great majority of people here in the United States, have one of those types of debts. And that's gonna be very difficult to keep up with, even though we have so many incentives out there right now where you can defer payments and you can push off mortgages. Eventually it's all gonna catch up. We will have to make these payments, but how will people be able to deal with that if there is so much loss in jobs, loss in income, and if we don't bounce back quick enough? So how do we tackle the issue of debt? And is that going to be a key item that, if we can resolve that, it would lead to a better economic impact and a better recovery? Who knows? So I would love to get your guys' opinion on it, and I'm gonna read through this article because this is actually one of the only articles that I found that kind of went into this, and I thought it was super interesting. And this came out 2 days ago on April 15th, so it is very current. Okay, so let's just jump right into it. This is a Barron's article, and it's called, "If You Want a Quick Recovery, Forgive Debts." If you're hoping for a quick recovery from the COVID-19 driven economic collapse, we've got good news and bad news. The good news is that we've studied the Great Recession and singled out a crucial factor in how fast the economy can recover, and that crucial factor is debt relief. The bad news is that right now, Washington isn't taking serious action to give people a break on their mortgage and rent payments, student debt, and auto loans, which are the common debts that so many of us Americans have. The crisis did not start in the household sector, but the problems faced by the households are similar to 2008. The record 16.8 million new job loss claims already filed have mortgage lenders preparing for the biggest wave of delinquencies in history. And I think a couple of days ago, banks like JP Morgan, Chase, Wells Fargo, they did release statements about how they were really bolstering up their cash reserves to really prepare for the people who are going to go bad on their loans and delinquencies and just loans that are just not going to make it. So kind of really interesting to see that they're already preparing for that. By our estimates, more than 30% of all borrowers could default on their mortgage, about 1.5 times the level of defaults during the 2008 crisis. That is a huge number that we should all be concerned about. As we learned in that recession, the pain of defaults does not stop with the borrower. The damage creates ripple effects that slow down the economy. Ruined credit scores make it harder for borrowers to get future loans. Foreclosed homes fall in value and bring down neighborhood property values. And cities suffer when borrowers have less to spend at local restaurants and business. So as you can see, it's a total domino effect. Washington has to move quickly right now because we know from the Great Recession that how we handle debt relief will critically determine the speed of recovery. Swift action can prevent the imminent surge of mortgage defaults from spiraling into a prolonged recession. We analyzed a decade of data and millions of US households following the Great Recession, finding that regions that did not receive household debt relief took about 4 more years to recover in terms of consumer spending, house prices, and employment than the ones that did. So 4 more years, that's quite a long time. In general, both household debt overhang and the foreclosures that follow mortgage defaults significantly hamper economic activity and slow down economic recovery. Washington has at least acknowledged this need. A major piece of the $2 trillion CARES Act is a mandate that all borrowers with government-backed mortgages, which is about 2/3 of all mortgages in the United States, should be allowed to delay at least 90 days of monthly payments and possibly up to a year's worth. And the fact that they're even preparing for up to a year's worth of payments, that is really a clue inside of what the potential impact might be. And for a lot of banks, I'm with a lot of banks that I have auto loans with for Turo, but I got a lot of emails because they also do mortgage lending saying that they were already offering 180 days. So that's already double the minimum, 6 months, and they're going up to a year. I mean, it's really interesting. This is an important first step that buys us some time, but it will not be enough and should not be considered a long-term remedy. These deferred payments will need to be made at a later time. Households already distressed because they lost jobs or income will have a hard time coming up with the money when the time comes. An even more important lesson from the Great Recession is that the method for distributing debt relief is critical. The CARES Act calls for relying on private sector loan servicers like Wells Fargo and Bank of America for debt relief. But we cannot and should not rely solely on the private sector because we have some evidence of how they respond. After the Great Recession, the Obama administration created programs in 2009 designed to encourage banks and lenders to refinance and work out mortgages. But many decided against it anyways because it didn't align with their incentives, which I wonder what their incentives are, if anyone knows. Some mortgage servicers felt they did not have enough incentives to restructure loans. Many banks and lenders felt borrowers didn't have enough equity. They didn't see a competitive need to offer refinancing, or they didn't want to encourage moral hazard. Several simply didn't have the organizational ability to conduct restructuring on a large scale. The results were discouraging. Even though these programs were designed to help 12 million borrowers, barely 5 were actually able to use them. In fact, loan servicers' refusal to renegotiate with the borrowers, particularly in the first year of the Great Recession, by itself accounted for upward of 2 million foreclosures. And I wonder if that's because for the banks, having that asset in repossession is probably worth more to them than trying to renegotiate their loans, possibly. That would be my guess. At a fundamental level, a bank or investor's balance sheet doesn't reflect the positive impact of an unemployed airline or hotel worker keeping their home and being able to spend more freely, nor will it reflect the adverse effects of the local economy of foreclosing a home. Banks and lenders have a fiduciary duty to focus on returns for their investors. Left to implement programs on their own, they are not likely to achieve the level of debt relief that the U.S. needs right now. And under the CARES Act, banks and loan servicers are now required to make up any shortfall in payments in the interim. Yikes. Just like in the aftermath of the Great Recession, banks and lenders will have the wrong incentives if we want them to help borrowers with their mortgage payments. Vulnerable households need permanent and quick debt relief. Washington can help directly. The easiest and cheapest approach would be to leave debt balances intact and instead forgive or take over the interest payments on debt, including mortgages, credit cards, and student loan debt. Since federal and state governments mandated the stay-at-home orders creating this downturn, it is only reasonable that taxpayers should not pick up the tab. A good policy would start by forgiving 6 months of interest and working directly with borrowers rather than relying on lenders for implementation. A reevaluation of the length can be done later when we have a clearer picture of the severity of the crisis. Renters, by definition, do not make interest payments and unfortunately wouldn't benefit. Washington should consider a special housing voucher program that offers relief to renters and avoids evictions. To make sure taxpayers don't overcommit, the federal government could impose eligibility requirements, targeting relief to those households that have suffered a documented loss of income or financial hardship. By our estimates, a targeted policy could cost up to $100 billion. Congress should start taking these measures into account when it returns to Washington to start work on the next phase of the economic rescue. If we do not act aggressively and immediately, we risk making the same mistakes that resulted in a prolonged and slow recovery during the last crisis. And this article was written by a few people. I'll actually cite it in my description down below, so if you guys want to take a look at it. But again, like I mentioned, I really like to keep an eye on this stuff and try to dig into what are some of the possible solutions. What is government thinking about implementing, especially in this case, because like this article stated, this was a mandate that was enforced by the government, which caused this sort of economic downturn. And I like to keep an eye on this stuff because I think that it is extremely telling in terms of what we can anticipate for the future and how that might affect our businesses. So really, really, really interesting. And I just wanted to put this information out there, just to put it out there and get some feedback from you guys and see what you guys think, and if forgiving debt, having debt relief really as a big part of the plan would aid in a quick economic recovery. So let me know what you guys think. Just a little news piece story for today. Thank you so much for watching. Once again, my name is Saimah. This is Saimah's Experience. If you like this channel, be sure to subscribe. And again, do leave me your feedback. I definitely want to chat with you guys about your take on a solution such as debt relief to help us get out of this mess that we're in. All right, guys, take care of yourselves. Stay healthy, stay indoors, and I'll talk to you guys soon. Bye, guys.